Good afternoon. You're watching the KPMG Africa Conversation series coming to you live from Johannesburg. A warm welcome to our regular CNBC Africa audience and, of course, our international viewers this afternoon joining us via webcast. We're focusing on transacting in Africa in today's conversation, and joining me now for that discussion is Eloise Smith. She's the Executive Vice President, Business Development at Standard Bank PLC. We also have Alan Field. He's Head of Tax and Legal at KPMG, John Gill, Head of Transactions and Restructuring at KPMG, and joining us from our Nairobi studio is Habil Olaka. He's the Chief Executive Officer of the Kenyan Bankers Association. Thank you all for joining me this afternoon. John, let's start with transacting in Africa and the basics. I'm a business in Johannesburg and I want to put together a deal for the African continent. Where do I start?
Yeah. Bronwyn, I think if you're doing that, you're acting on a strategy. So you would have ideally identified a territory, a region, a market that you want to get into for a particular reason. And once you've identified that market, where you'd start is by trying to identify the strategy, either organic growth, going in and starting from greenfield, or going in and trying to do a transaction with an existing entity and buying a stake and using that entity as your launch pad into a country. So I think it's starting by looking at the territory, the reason for the transaction, and then you've got to do a lot of work to try and identify the right entity. So it's a counterparty transaction identification process. So that's where it would start. And then from there, if you do that and you have a short list or an entity that you want to transact with, it's then, even from that stage, a very long process that you've got to go through. So from identifying the party, then trying to identify that the entity is for sale or will interact with you, engage with you, and allow you to engage. And then it would be negotiations, due diligence, contract closure, and a whole long process before that transaction gets concluded.
If you're looking to grow, Eloise, is the best route to take the joint venture route in terms of understanding the territory that you're going into, partnering with a local partner?
I think it depends, Bronwyn, on the industry that you're in and your strengths particularly. I would say if it is in the mobile industry and you are very confident of your ability, you have done this before in other markets where you have gone in, then it might be easier. If it's in the retail sector where really the consumer-driven behavior is key to your success, I would say very often if you can identify a local partner, that would be the correct way to go. If it is a big mining operation where there are no requirements from government to have a local partner, but you realize that there will be certain sensitivities, that's another consideration for taking a local partner on board. So it really depends from country to country, your specific expertise, and also the industry that you are in.
And Alan, a number of people who embark on this route would suddenly look at the tax regime and the differing tax regimes across the African continent and go, actually, this is far too complex for me to pursue. Do you find that happening a lot?
Well, I think, Bronwyn, an investment into Africa is essentially an economic investment, not an investment for tax. And very often investors are attracted by the returns they can get. And tax is really looking at it from the point of view as how can I make sure I get the maximum return from my investment into Africa. So yes, I'd look at it from a jurisdictional point of view, see what the taxes are in each jurisdiction, and essentially try to maximize the returns I can get out of Africa if I were an investor. And the kind of investment you're making, if it's a private equity investment, make sure that you're looking at the returns you get because you can get a deduction for interest. What kind of returns can I get after I extract the dividends out of that investment? So a lot will depend on the kind of investment you're making in the jurisdiction and what kind of legislative framework exists for the investment in that particular country.
Are transactions on the African continent the ambit of big multinational players with significant cash on balance sheet, or are small businesses starting to go alone in terms of saying there's a growth opportunity in Africa, how do I take advantage of it?
Bronwyn, we're seeing absolutely both of those happening. So it's a combination. Certainly you see the big multinationals now no longer ignoring Africa. I mean, so often, or historically, people were saying there was a risk in investing in Africa. I think we're now seeing people seeing it as if you don't invest in Africa, there's a risk, because this really is a new growth frontier. So it's on both fronts. So you're seeing big global multinationals coming into the region, but at the same time, when we act, and even for small parties, we're seeing smaller entities seeing an opportunity that they can move and be nimble. And so it's not just the big multinationals, it's a combination of both.
Habil, let's move to Nairobi and get your opinion on what you're seeing in the financial services and banking arena when it comes to transactions that are being closed out at the moment. Let's get your view on the ground, so to speak, sir.
Yeah, thank you very much. What I can see happening in the local market is that banks are coming in to play a much more significant role. You know, one of the things that we have been trying to push for is the agenda of financial inclusion. And economic growth in this part of the region is mainly being pushed forward by the SMEs. And SMEs are some of the entities that are, so to speak, financially excluded. And so banks are trying to push forward their financial inclusion agenda to bring in the SMEs purely to grow the market.
One of the challenges, obviously, in the financial arena is that a number of these territories are overbanked. There are just too many players in country. Is that something that you're encountering on a regular basis, or your clients are encountering?
Sure, and I think one saw that particularly, say, in Nigeria, where there was a lot of banks, and from a regulatory perspective, they actually went in and started to make changes in legislation and forced a consolidation in that region. So that did happen. So there was a particular region that had issues. But the sense is, from an overbank, it's very attractive. So we're still seeing, our view is that there's globals looking to the whole African continent, haven't been yet to gain a foothold. And even the South African banks and other African banks are looking to have a full presence right across the continent. So there's still consolidation in the space.
Habil, throwing back to you in Nairobi, I think we need to get your sentiments on that front as well. John, throwing forward to the fact that we have seen consolidation in the Nigerian banking sector. Do you think we're going to see similar moves when it comes to the East African community, and that sense that right now, let's take, for instance, Tanzania is sitting in a highly overbanked position?
Yeah, what I'm currently seeing is that there's a move by even the regulators to try to, for example, increase the minimum capital requirement for the banks, and that effectively will be a message to the banks that they may need to, for example, consolidate to be able to survive in the new environment. And so, if you are looking at, for example, the Kenyan market. Initially, the minimum core capital was 250 million shillings, but now it has been pushed to $1 billion by the end of this year. And there is a clear message that this may be pushed further up going forward. And so we possibly may start seeing a number of entities consolidating, and that was already been felt in the Kenyan market. In order to reach the $1 billion shillings at the end of this year, a number of banks have had to combine or raise capital from alternative sources.
With the higher capital adequacy requirements, and Alan, I'm going to throw this to you, do you think that it presents opportunity for international banks to come in and perhaps partner with a local bank and create that gravitas when it comes to balance sheet?
Well, I think that from the point of view of partnerships, we certainly have just recently seen a bank in South Africa going into Nigeria. Whether they're going to partner or not, that's going to be up to them to partner. What I would like to do, just in terms of the question you've asked me, Bronwyn, is to say that banks are going to have to look at the environment of the different jurisdictions and decide where it makes sense to come in and invest. Because we talk about coming into different jurisdictions. I'm just listening to the conversation here, and I think there's certainly some jurisdictions that are more attractive for banks to come into than other jurisdictions. So yes, there may be overbanking, but I believe that there's also a matter of talking of investing into Africa, but we've got to acknowledge that Africa is a huge continent with many, many different countries. And I believe that we've got to acknowledge that you can look at Africa sort of as an amorphous mass, but what we must recognize is each country has an attraction, and a bank wants a stable environment to invest into. We don't have a stable environment in every single country. And so I think banks are going to look at different countries and say, I'd like to come into these jurisdictions. They're more developed from a fiscal point of view. They've got legislation that's more attractive because it's more developed, and a bank looks for something more developed. A bank looks for a jurisprudential environment, in other words, which has a better legal framework. They're going to look for those, and maybe maybe partner in those kind of environments, and they're going to look for something where I think from a tax point of view, the administrative environment is more developed. Now, look across Africa, you'll find some that are really like that and some that are not. And that's where I think you're going to find banks saying, yes, I want to come in and partner, when that kind of framework is more in place.
Absolutely, and the terminology that we're throwing around at the moment is transition economies and pre-transition economies, to your point, Alan. So your transition economies, the likes of a Mozambique, Kenya, Zambia, and your pre-transition are where you've got that additional country risk and the political risk, and throw in Mali or Senegal. Would you agree with Alan on that point?
I fully agree. It's always a trade-off between risk and reward. Just following on Alan's point, for banks also there's an additional consideration: where are our clients? And that's an additional. So a client, and many of the opportunities on the continent are not necessarily in the most stable countries with the best developed environment. So while that is the ideal, if you only focus on those, then you may miss out on opportunities. You're not in the markets where there are huge resource booms currently undergoing. And I think the challenge, therefore, from a banking perspective, but also for other companies looking at the continent, you really have to understand what is the opportunity, what is my strengths, how do I best play to those, and how do I mitigate risks? Because every environment you are in will have certain risks. And what are acceptable risks in terms of the opportunity?
Shallow capital markets. This is a problem that plagues the African continent, and we certainly have this discussion in every conversation around Africa. What is the solution?
Well, I think it's a combination. Clearly you're seeing from the JSE in South Africa setting up an African market to try to attract and help companies in terms of raising capital through the formal capital markets. But I think we're also seeing an emerging sovereign wealth countries coming in to Africa. You're seeing the likes of China coming in with very different models to what we've seen in the past. So for big infrastructure projects that may not easily have been financed in the past, they come in with solutions and cheap finance, maybe for offtake arrangements. So I think we're going in through a whole new period. So there's the capital markets, there's countries coming in with solutions, with sort of turnkey solutions. And I think then you're also seeing that it has been difficult over the last 4 or 5 years with the financial crisis, and the cost of debt, cost of financing has been higher. But there does seem to be an improving sense of stability on the debt markets. And so it's not just the formal markets. I think each country would need to look to, to what market and how they can assist the debt and fundraising potential. You've got private equity too that has a role to play in this, in helping companies transact as well.
Eloise, it looks as though you want to add there.
Yeah. I certainly think that it's very often the cost of debt that is the difficulty. Debt is available at a price. Our banking markets have developed. There's been a bit of a pullback in the last couple of years as a result of the crisis. But more and more commercial banks and other investment banks, not only South African or African, are getting an understanding of the continent, how it drives. It's not this, we are simply closed on country X. Most of the countries on this, if it's structured correctly, can access funding from a variety of sources. Private equity is increasingly playing. The biggest challenge, I would think, is for the long-term infrastructure projects, where we need tenors really up to 10, 12, 20 years to really make it viable. And that is where private equity cannot necessarily play a role. They want an exit in the shorter term. And that, talking to that point, that is perhaps one of the other challenges that we see, where a lot of greenfield opportunities cannot be accessed by private equity because of the problematic exit, because our capital markets and our equity capital markets specifically are not that developed.
The financial crisis of 2008 certainly set private equity back within the South African space. What did it do to private equity on the African continent? Did it manage to escape the negativity?
Well, I think private equity on the African continent is still relatively new. But what is happening at the moment is it's starting to gain momentum. There are funders that are very excited about the opportunities in Africa. What we do have in Africa, which is not as developed in South Africa, we've got legislation that's going that way, is we have thin capitalization rules. We are needing to look at whether the private equity investors can extract their funds from Africa, because that's a big deal. We do have controls, foreign exchange controls about getting the funds in, getting the funds out. So it's uncharted territory, frankly, at this stage, but it's developing. And, you know, funders are looking at it with wide-eyed. And they're saying, here's an opportunity that's untapped. And I believe over the next 5 years, instead of people concerning themselves with the old days of the wars that exist in Africa, there'll be wars about fighting for the opportunities that exist in Africa.
Habil, staying with this private equity story, are private equity players being embraced in the Kenyan environment or within the East African community?
Yes, we have seen quite a number of private equity fund players coming into the market. A number of them have raised funds and are trying to penetrate the market. A number have actually been set up, not just in Nairobi, but within the East Africa region. But most of them are somehow basing their base in Nairobi.
You wanted to add there, John?
I just wanted to add, just on this private equity space. There have been a lot of big South African private equity houses that have focused a lot in South Africa. But at the same time, some other big African-focused private equity houses, so the likes of an Actis that plays both in South Africa and across the continent, Helios, Aureus. And in this last few years, these entities have raised a lot of funding for the African continent. And you've seen traditionally or historically South African-focused private equity houses having to start and changing their mandates and looking at the African continent. So we think that private equity, whilst there has been a lull and for finance debt raising requirements or reasons, going forward, we actually think that's going to change quite a lot, and private equity will play out quite significantly across the continent.
Eloise, obviously we've been having this African story conversation on CNBC Africa for a long time now. And there was a time when we used to say, John referred to the Chinese and the money coming in from China. There was a time when we said, well, the Chinese are just after resources and they're going to get it at any cost. And there was a negativity, a pushback towards Chinese and perhaps also to India. Do you think that conversation's over? Now we're embracing what the Chinese can bring and that they can actually help improve the environment on the African continent.
We certainly see the Chinese investing not only in resources but also in infrastructure. They're building roads, they're building hospitals, they're building all over the continent. And I think from that perspective, there's certainly on the ground in Africa a lot more positive because everybody is benefiting. In Kenya, a lot of the roads at the moment are being built by the Chinese. It is in the same thing in Ethiopia, Angola, etc. So you have select pockets of resistance still. There may be negativity about how workers are treated in Zambia, etc., that comes up. But definitely, I think even businesses and other companies active on the continent are starting to see the Chinese as partners and investing in the infrastructure that is so critical to do along the whole resource boom, but also to enable, whether it's the power, the infrastructure that will really enable the growth that everywhere is forecast for the continent.
Are South African companies partnering with Chinese players and then conquering the African continent?
I don't think South Africa's taken the opportunity like China has. I can't answer the question of whether I know of South African companies myself that are partnering. But I would like to add something to the previous question. Might I do that?
John wants to take the partnering of the South African companies with the Chinese.
We have Standard Bank here that RCBC are a 20% shareholder, so there's a partnership we can talk to right away.
Why didn't you just bring me to that point immediately? It escaped me completely,
Right, yes,
of course,
and
completely remiss on my side. But you wanted to
But I did want to say that you can't dig a hole in the ground and get the minerals to the ports without building a railway or a road. So inevitably you can't communicate without some kind of infrastructure. And so ultimately, you know, from the very mine all the way to the ports and the building of the port is infrastructure. It has to happen like that. And so the Chinese that are investing and might have appeared to be some kind of irritation that was, robbing this continent are in fact developing as they go along. And this is what's going to happen in Mozambique as well with the discovery of the gas, coal and so on. How is it going to happen unless there are roads or railways that are built? It has to go hand in hand.
Habil, coming back to you in Nairobi as the Chief Executive Officer of the Kenyan Banking Association. Sir, are you spending a lot of time whining and dining Chinese players?
Actually, that's a very interesting debate that I was listening to as we were discussing it. I mean, there are 2 points I think I would like to add there. That one is that the capacity of the local players is such that some of the projects that are being implemented, especially in the Nairobi scenario, might be the size of the projects might be too high for the level of capacity available with the local players, and so. Even though they might sit and whine and complain about the Chinese invading their market and taking up the business, but I think the ability to deliver on the projects can be put to question. But 2, I think that at the end of the day, they're not losers, because what happens is that as the Chinese take up these big infrastructure projects, there are other secondary businesses that are arising and falling along the line, and the local players are able to take those businesses that go along with the big infrastructure projects. So at the end of the day, it's, I think, a win-win kind of scenario, and that's where we see our support to the SMEs that are providing those secondary services becoming useful.
Hot button areas when it comes to transacting on the African continent. What are we seeing? Traditionally, we speak resources, infrastructure, oil and gas, the mining, obviously, environment linked to resources. The consumer play seems to be very big at the moment. What's the hottest area?
Well, I think you've touched on this. We've really seen 3 mega trends, if you want to. One is around energy, natural resources, oil, gas, mining. I'd add agriculture into that, so food security is very big worldwide, so that's part of the natural resources. The second is consumer-driven demand. So you have on the African continent now an emerging, unprecedented middle class coming to the fore and now demanding goods. So, and that drives the retailers moving into spaces, the consumer goods, the Tiger brands, etc., moving onto the continent. That leads to the financial services players, the MTNs for telecoms. So that's the second one, and then the third one we've touched on quite a bit is the infrastructure space. So those are the 3 trends that we're seeing, and I think right now a lot of activity in that middle consumer markets-driven space. You saw Walmart and the Massmart transaction last year. You've seen Tiger Brands announce transactions in West Africa, and we believe there's more of that to come.
What transactions in what sector are you mostly dealing with at the moment, Alan?
The mining sector is no doubt one of the biggest.
So does it continue to hold center stage, mining?
Mining continues to hold center stage. The big issue for us, if I just hear what's going on, and I can't disagree. It's almost obvious that these things are happening. But I think there's an area that has to go beyond the mining, and that's the beneficiation. Because at some stage questions are asked, are we in fact going to end up with a lot extracted and then not a lot left? So that's obviously important, but we are dealing with those areas and issues around, is there going to be some sort of nationalism that we have to take account of every time there's an investment? And then, the other areas like the continent is growing with a huger number of people. By 2040, the number of people is going to double on this continent, it's suggested. So this is a massive quantity of people that are urbanizing, that potentially need to be, in fact, need to be educated. So with that kind of demand, there's a capacity to supply services. And if we can just educate those people, we can have a lot of opportunity to supply services to the rest of the world, like India is at the moment. So it's outsourcing opportunity. And we've discussed, like we have, what the consequences are of outsourcing, and can we get ourselves to outsourcing opportunities. But from a tax point of view, it's the obvious things around what we're talking about in the mining area and retail and so on.
How are we dealing with this potential resource tax nationalization? Keeps making the headlines again, even in South Africa. And of course, this is a key concern for foreign direct investment into that mining space. Do you regularly encounter conversation on that front and the risk associated with it?
All the time. It's a big area. The issue is that I think it's probably more of a talking point than a reality. In most countries, there's some kind of nationalism, some kind of extra tax that's going to be applied. But at this stage, we constantly have forums with our clients, discuss what the issues are in the different countries. And we have specialists that deal with it all the time, economists and our mining tax specialists. But, you know, again and again, the issue is the returns are big enough to make it worth it to invest in these countries. And so the economics keep driving it. And that's why there's constant foreign direct investments into these areas.
Habil, we are going to be losing you in the next segment. So I need to get a sense of whether you think we are starting to look at Africa as regional plays. So certainly the conversation that I've been having more and more often now is that we're starting to talk about the East African community as one block, and it's starting to operate as such, and perhaps it's leading the way in terms of these regional plays. And then of course you've got ECOWAS in West Africa, you've got the Maghreb Union, which covers your Arab states, and you've got SADC, which covers your southern states. Is that the way forward, and do you think that you are leading the game?
Yeah, I think certainly it's taking root, and given the examples that you have mentioned, really, and where we in Kenya, where we belong with the EAC, I think that's the way forward. Because under the EAC, the members are really putting the measures in place to ensure that the EAC as a community survives this time. And eventually, I think they are really committed to making it a political federation as the ultimate objective. But currently, a number of them are meeting quite a bit of challenges, but meeting them step by step.
Habil, thank you so much for your participation and your insights, sir. And John, thank you very much for joining us. You're watching KPMG Africa Conversations, coming to you live from Johannesburg. We're taking a short commercial break. We'll see you on the other side.